I have a worldview in which I don't think DeFi protocols should change. I think DeFi protocols themselves should be as open and composable and permissionless as possible. I think certain assets, certain tokens should be permissioned. And I think when you combine completely open, completely composable, you know, DeFi protocols and assets, some of which might have to be KYC'd and some of which are completely permissionless, you get the best possible end state.
Here we are with Robert Leshner, who needs no introduction to our audience, but still co-founder of Superstate and Compound. Robert, it's so great to finally have you on the Defiant podcast.
Cami, thanks for having me on.
So Robert was one of I think probably the first DeFi founder interview I ever did when I was at Bloomberg back in 2018 and had just like very little idea of what DeFi was. I don't think anyone had any idea what DeFi was at the time.
I still don't know what DeFi is, to be honest.
Yes, good answer. Okay, so obviously from Compound, now you are at Superstate. You pioneered decentralized lending with Compound, and now you are doing something very different, tokenizing real world assets with Superstate. I'd love kind of what was the thought line between those two, and wondering your view of on-chain / DeFi finance has changed.
So here's the thought line. When I first founded Compound starting in 2017, I predicted somewhat incorrectly that all assets would wind up being tokens and blockchains. And when we launched Compound in 2018, when it was running in 2019, 2020, 21, 22, 23, all of the assets that you could use in Compound and any DeFi protocol for that matter were really crypto native assets, tokens, oftentimes of other crypto projects that were issued on a blockchain for the first time. They weren't coming from, an off-chain system. They were basically being issued on-chain. And this was amazing because this allowed people to prove out the functionality of DeFi protocols and autonomous pieces of software that could create new products and marketplaces. And I always thought that, that would change, right? I knew that was going to be the case when we first launched Compound. I just assumed though at a certain point, the tokens that you'd use on chain and DeFi protocols would start to be stocks and bonds and real estate and commodities and all these other things, as opposed to just the tokens of other crypto projects. And the whole thing for me felt very self-referential, and that the ceiling for how big things could get was really limited until, as a society, we start to bring in all of the assets and value that didn't live on a blockchain yet. And to have not crypto native tokens be the primary assets within DeFi protocols. And so for me, that was like something that I couldn't stop thinking about. And I said, okay, well, I want to figure out how to bring all of the stuff that's not yet composable with DeFi on chain so that it can be composable with DeFi.
That makes a lot of sense. For that to happen, probably the biggest roadblock has been a regulatory one. How to do this in a compliant way. And others tried to do that before and it didn't pan out so well. So what's different now? And if you can kind of go through how you've solved these problems.
Well, there's actually a lot that's different now than, 8 years ago or 7 years ago, right? So people have been trying pretty much since as long as Ethereum has existed to be tokenizing securities and tokenizing off-chain assets. It hasn't really picked up until the last year or so. Part of that's regulatory, but there's a lot of other factors going into this. So here are the sort of core building blocks that I think are necessary to tokenize off-chain assets at scale, right? Yeah, obviously you can do one-off experiments. And over the years, we've always seen one-off experiments that haven't really gotten any traction or critical mass, but, have been done, to put a flag in the ground. So here's the core ingredients that are necessary that have to come together. So the first are issuers, right? Whose assets are coming on chain. In the past, there have been like a small number of people willing to like tokenize their assets or wanting to, but the number of issuers of assets has been pretty low. And that's really started to change over the past 2 years, right? That's the first piece. The second piece are the use cases, right? When I started in 2017, there was nothing that you could possibly do with a tokenized asset once it was on chain, right? Besides hold it in your wallet. Any asset that's owned off chain, metaphorically speaking, already sits in someone's wallet. Bringing it on chain without DeFi protocols to use it in or new use cases doesn't really accomplish much. And so, the use cases are here, right? We've been proving out amazing DeFi use cases for 8 years now. Okay. That's real. Then there's the demand. How many people want to hold a tokenized security? And all of the one-off experiments that happened over the last, many years, the number of people that wanted to own this stuff, really small. We're just now getting to the point where a lot of people want to own this stuff. And lastly is regulatory. And you mentioned this. I also see this as like a hugely important, ingredient, but it hasn't actually changed that much. So in some ways, it's changed less than people think. Most of the assets that people are tokenizing are securities. We've known they're securities for a very long time, right? At Superstate, we are tokenizing securities. We're not tokenizing commodities yet. We're not tokenizing things that are not securities. We're tokenizing things that are very obviously securities. There's nothing that we can do right now that we couldn't have done from a legal and regulatory perspective a year ago or even 3 years ago. What has changed dramatically is everyone else's willingness around us to interact with these assets now that we're starting to see incredible regulatory clarity. What I mean by this is I could have launched a T-bill fund and tokenized it under Gary Gensler 4 years ago. Would people want to interact with it, touch it, add support for it? Would institutions want to use it? No. Because even if it was legal, they would have faced, a lot of compliance costs, investigation costs. They would have faced all sorts of additional costs, and it would have been a burden. That's what's different, is that it's not a burden now. So if you talk to any institution on Wall Street, you're like, hey, would you like to interact with tokenized securities? They're like, actually, yes. We're incredibly excited about this. And, we're incredibly excited by the tailwinds coming from the SEC and creating regulatory clarity. And so it's not that things went from being illegal to legal, right? What really switched from a regulatory perspective was, an extremely cumbersome headwind to, a tailwind of, call it even like soft support, right? There are no real new policies that, flip a Boolean from a 0 to a 1 here. We just see a much more accommodative atmosphere. And this is a very institutional market. For institutions, knowing that they're not at odds with their regulator is everything. And so the regulatory stuff is an absolute game changer. And it has absolutely been one of the things that started to create this catalyst for tokenized assets. But it's not that this was illegal a couple of years ago. It just wasn't encouraged. It was discouraged.
No, that's a great point. And so speaking of institutional demand, I think what I've seen at least is from institutions, there's been a lot more appetite to issue assets on chain, right? Like BlackRock with Biddle, Franklin Templeton, and so on. They're issuing their tokenized money markets. But are you seeing demand from institutions to actually buy these tokens, or is demand really coming still from more crypto native players?
Yeah, it's a great question. Let me walk you through the product suite of what we're tokenizing, because I think there's some differences. So the first product that we launched was a tokenized T-bill fund. The second product we launched was a tokenized basis yield fund. And the third product that we're launching are tokenized equities. So all of these have a very different audience to them. In general, it's all crypto native. And why is it entirely crypto native? It's because right now the people that want to hold a tokenized asset on a blockchain are people that are using crypto wallets, crypto custodians, crypto rails in general. We're not yet to the point where tokenized securities are the thing that happens under the hood for traditional market participants. Eventually TradFi players will be using tokenized things under the hood, and they won't, say, oh, I'm using crypto. They're just going to know that things settle faster. They're more programmable. They're just more efficient and better. But right now, we still are in a moment where all of the users are crypto first. On the T-bill side, there's a lot of demand from, stablecoin projects. There's a lot of demand from, applications that are looking for a risk-free rate that they can embed underneath their product in a composable and programmatic way, right? There are some crypto hedge funds, crypto venture funds, people that are saying, oh, let me take, stable coins and have a productive use for them, and tokenized T-bills that I can enter and exit quickly. But it's for the most part people that are just looking for a very basic risk-free rate that they can enter and exit quickly. And that's honestly very composable. And so we see a lot of demand from an application developer more than anything else. Our basis product, it's risky, right? It goes up and it sometimes goes down a little bit, right? Because crypto markets are volatile. So it's a high yield product with a little bit of risk there. And so it's not really suitable as a building block in the same way for a stable coin, let's say. And so the use case there actually, instead of being very application focused, is significantly more speculative focused. And so the users of it are oftentimes, people that are comfortable with risk. It's a lot of crypto native hedge funds. It's players that are actually using this composable with DeFi. So our, basis fund is integrated into Aave Horizon, which is an RWA market. You see a lot of people levering it up and actually using it as a composable asset. It's a lot of sophisticated players. It skews much more hedge fund than it does applications. Although, we've recently announced like a couple of weeks ago that, Spark, the Sky/Maker project was integrating USCC. And so we do see some protocol adoption there, but it tends to be much more crypto native speculative. And then lastly are tokenized equities. And these are really a nascent immersion product. We haven't yet turned on a lot of the use cases for end users to be able to use them. Right now, we're really just in a testing phase. And what does that mean and who's using it? Well, right now, what we're doing is, we're approaching tokenization of equities a little bit differently than other projects. We're not, a startup that goes out and buys 100 different stocks and puts them in 100 different SPVs or holds them at a custodian or in a trust and then issues tokens against them. Our model of tokenization is actually quite different. We offer what we call native tokenization or canonical tokenization. And so the way this works is we're basically the infrastructure for a public company, someone that's trading on the NASDAQ or New York Stock Exchange to tokenize their own stock. And we're their agent and issuance platform. And so when a company tokenizes their own stock, it's their official stock. The same shares that trade on the NASDAQ or New York Stock Exchange is now a token on the blockchain. And what this means is that you can, through a relatively, for now, clunky process, you can actually migrate shares between a brokerage account and a token on the blockchain and back again. And so right now we're really testing. We're testing moving shares from brokerage accounts to tokens to brokerage accounts, and making sure the sort of underlying infrastructure of equity tokenization works before activating a lot of the DeFi use cases and really seeing for the first time who are the users of this stuff.
It's so interesting. All these use cases, but I'll ask you follow-up questions on specifically tokenized stocks. We're seeing so many players focus on this use case. And yeah, they all have kind of their different approaches. Yours is super interesting, kind of to make the tokenized stocks the actual equity of the company. But if this is the path forward, how do you see just the broader tokenized equity market evolving? Do you see kind of tokenized equities will be from just new companies issuing stocks, or within Superstate do you have a path forward later for existing equities to also come on chain?
Yeah, absolutely. So I want to preface by saying I think both overall models of tokenization work and will exist. I think there's the Superstate model where it's like the canonical stock. There's disadvantages of this model. It doesn't scale as effectively. We have to work with issuers one by one to bring new tokenized equities to market. The other model, any startup, like even a startup that's like a day old, can basically go and tokenize the top 100 stocks. They're making an entirely new asset when they do that. There's like weird credit risk associated with the startup. There's differences in like what are the rights of the tokens, but it's extremely scalable. Any startup listening to this podcast could probably go and make their own wrapped stock relatively easily, right? And so I think there's actually a really interesting opportunity for both. I think institutions and the existing financial market structure is going to strongly prefer the Superstate model, which is, hey, this is the same stock with the same rights, the same governance, the same risks. It's not a different security. And I think retail and I think international users are going to strongly prefer the second model. Yeah, we don't care if it's a new asset. As long as it tracks the price with like 99%, correlation and has basically the same liquidity, what's it matter, right? I think it's going to be much more retail focused, and I think that's where it's going to see success. And so right. I think both models are viable. I just think they have very different customers long term.
And then, well, all of these use cases and RWA market as a whole right now is still really small, right? I think it's 300 million.
Nothing. Yeah. It's like we haven't even started yet.
It's a blip. Yeah. And you mentioned like right now it's mostly crypto native. So what's it gonna take? Like, where does the next leap come from? When do institutions actually start, buying these stocks? What use case do you think is gonna be the thing that makes this a larger market?
Yeah, it's a great question. I think it's DeFi. I mean, frankly, most people, including most people around the world, have the ability to buy stocks right now. That doesn't really change with tokenization, frankly, right? It does. I think it's being able to do interesting things with these in DeFi protocols that's going to be the tipping point. When stablecoins came around, and I was there when stablecoins really picked up in 2018, very few people wanted stablecoins. It wasn't until it was like, wow, like you can use these in every single type of DeFi protocol that, you really started to see explosive growth. And yes, there's a lot of activity outside of DeFi protocols, but that was what like blew it up, frankly. It was like, okay, like you can trade on chain, you can borrow on chain. There's lots of markets being created on centralized exchanges for these things. You can move it between a DeFi protocol and a centralized exchange. It just became incredibly useful with new reasons for them to exist. And so, people have had dollars for hundreds of years. Stablecoins clearly better. I think tokenized equities and tokenized securities more broadly are going to go through the same thing until there's real use cases in DeFi, in centralized exchanges, the ability to move between the two very seamlessly. I don't think people are going to prefer the crypto version of things. The Robinhoods of the world, as is, the Vanguard, the Schwabs, whatever brokerage account people use, they're pretty good today. They're not perfect. They're pretty good. Right. And so I think it takes like this step function of offering something new before people will say like, oh, actually, I strongly prefer the crypto version. Like, there's reasons for this to migrate from my wallet into the crypto version.
I love that insight. But, in that world, DeFi becomes something different, right? Like there would be a KYC aspect. It wouldn't be like truly permissionless. What do you think? There could be some kind of counter argument to this model where DeFi grows with the tokenization of real world assets, and it just becomes gated and permissioned. What do you say to that kind of line of criticism?
I have a worldview in which I don't think DeFi protocols should change. I think DeFi protocols themselves should be as open and composable and permissionless as possible. I think certain assets, certain tokens should be permissioned. And I think when you combine completely open, completely composable, DeFi protocols and assets, some of which might have to be KYC'd and some of which are completely permissionless, you get the best possible end state, which is, some users won't be able to touch this token because of the geography they're in, or because they're not accredited, or because X, Y, and Z. But a DeFi protocol will be able to bring all of those under one roof and say, oh, we have permissionless assets. We have, geo-blocked assets. We have like accredited blocked assets. We have all of it, but the DeFi protocol can support it all. Unified model. I think that's the future. And I think in that world, like, yes, an individual shouldn't necessarily have access to every single asset if it doesn't conform with the laws. Like I don't believe in illegal assets. I believe in legal assets and radically open infrastructure for them to run on. And I think you'll have the compounds and Aves and Uniswaps and Curves and, everythings of the world one day supporting a mix of stuff. And that's good.
What's your view on how just broader finance looks like under this model? Like, do you think all assets come on chain and everyone is able to transact in DeFi freely? Where do you see this kind of convergence of two worlds going?
I mean, the people that are using DeFi protocols, the people that have their money on chain right now are crypto power users, right? It's, in some cases, and we're starting to see this the most with stablecoins, we're starting to see DeFi become like infrastructure for traditional applications, right? We're starting to see a lot more fintechs trying to use DeFi under the hood. And it's something that we've been predicting. I mean, like you and I and most of the people listening to this program for years now. It's like, oh, DeFi will be infrastructure. We're not seeing this with most assets. We're not seeing this with most tokens. Most tokens are not being used outside of like the crypto native on-chain, mostly speculative stuff. But we're starting to see like underlying infrastructure for mostly stablecoins. I think that's what happens next as we see, DeFi become underlying infrastructure for equities and for things that there's innate demand in traditional markets for. And I think that's where it goes. And what happens next is like we see DeFi plus tokenized securities eventually start to power all sorts of stuff that the end users aren't even knowing that they're interacting with crypto.
In this world, which DeFi primitives or protocols win?
To be really simple about this, there's only really 3 core primitives, okay, in general, like to this day, right? There's obviously a lot of edge cases and new stuff and but you have DEX, you have borrow lend, and you have perps. Those are like the 3 crypto most important primitives, right? Yes, there's a lot of other stuff. There's a lot of other DeFi applications, but like those are the big 3, you know. I think you're going to have tokenized assets playing a huge role in all 3.
And then finally, very curious on the lessons that you took from Compound, and how you're applying that to Superstate.
Yeah, I mean, there's a lot of lessons. I mean, like endless lessons. One of them is that, decentralized governance and development really slows things down. We've seen this, sort of reality play out from so many different projects in crypto, as they shift from like a very centralized team to a decentralized team. And, I don't think that, succeeded very well with Compound, frankly. That shift from like, oh, one team does it all to, hey, the community can do it all. Like that was a really like rough transition that I think slowed things down tremendously. And so, at Superstate, if we were to have a token, it would be very far into the future. It would not be early on in, the sort of life cycle of things.
Interesting, that hint at a token there.
Oh, I'm not hinting at a type. I'm just saying, like, I've gone through the shift from, centralized to decentralized, and like, it's a headwind. Like, it really is.
Awesome. Robert, well, we'll have to do another one of these. But amazing to have you on the show. Thanks so much. And yeah, super exciting to see what you're doing with Superstate.
Thank you.